All right. Well, good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, our Friday afternoon getaway into the weekend, all the latest happenings in the real estate and residential lending industry. And as I am joined every week, happy to be joined by Rob Chrisman. Rob, great to see you. You've been hyping up the secret location, Area 51, in the bunker with Dick Cheney. We reveal the location.
Yeah, we're going hunting this afternoon. Actually, Rich, I'm on assignment south of the border. And that doesn't mean the Ohio-Kentucky border. It's the, I'm in Mexico.
Good for you.
Mexico, I like it. And this week, a very, very special guest, Jim Cramer's go-to housing authority. She was Michael Lewis's go-to when he wrote The Big Short on the housing market crash. She very famously predicted the top of the housing market in 2005, a little over a year before all hell broke loose. And then again, predicted the bottom in 2012, very famously, before things really started to rebound. And she is one of the most renowned and acclaimed housing experts in America. And she's from Cleveland, the CEO of Zelman and Associates, Ivy Zelman. Ivy, thank you for being with us.
Thank you. Thank you for both having me on. By the way, I'm not from Cleveland. I'm a very proud New Yorker. I'm just a transplanted Clevelander.
Well, listen, Cleveland, we're going to take credit in Cleveland for anything that has any connection. We're still.
Listen, all three children were born in Cleveland. So, it's our home.
Right, Clevelander. So, but thank you very much for being with us and really looking forward to the conversation. So,
Great.
Rob,
I'm all yours.
Mexico. What do you on assignment in Mexico for?
So let me tell you a quick Mexico story. Ivy, maybe you don't even know this. Many years ago, many years ago, I'd gone to Mexico and I was returning to the United States, and I was telling somebody who worked for GMAC, it was Tracy Lewis, I think his name was Tracy Lewis. Hey, the funny thing about Mexico, I said to Tracy, was, you drive down the road and you would see all of these houses, and these houses would have rebar sticking out of the walls, sticking out of the roof. I said, we couldn't figure it out. And he goes, well, the explanation is easy, at least at that time. If the house was not finished, then you weren't reassessed for tax purposes. And so what people would do is they would, in essence, finish their house, but still have rebar sticking out. And so they could claim to the government, we're not done yet, even though it was done, because the rebar was sticking out. It wasn't done, and they weren't reassessed, and they didn't have to pay the higher tax rate. So if you guys ever go to Mexico and you see a lot of unfinished buildings that look like people are living in them, that could be why.
Very interesting. You'd think the Mexican government would figure it out, but then again, having the government figure anything out any government doesn't seem to be in the cards these days.
No. I'm just down here, Rich, working from a different place, writing the commentary, doing my consulting from a place here on the coast.
Excellent. Well, let's get right into it. And no shortage of things we want to get with Ivy on. But Ivy, first, you just came out with a book. So Gimme Shelter, it's called Hard Calls and Soft Skills from a Wall Street Trailblazer. Kind of goes into your past growing up and how it kind of shaped your career. Tell us a little bit about the book before we get into the meat and potatoes of everything going on in housing.
Well, it started out, thank you for asking. It started out as a project that really I thought about right now, it was about 2 years ago I first started it. And I work a lot with young people that are either in high school or attending university that want to pursue a career in Wall Street and don't really know how to navigate it. So really it was a pay it forward, a way to inspire and help others. And also at the same time, tell my story that hopefully gets a few smiles and laughs along the way, and some of the details of my career and how I got where I am today. So hopefully you'll enjoy it if you haven't read it yet.
I have a question. So there was a band, maybe they're still around, and I think they're called The Verve. I should have looked this up before our session. And they were kind of a one-hit wonder. They were a one-hit wonder until Mick Jagger and Keith Richards sued them because they used some bit of a song written by Mick and Keith. Gimme Shelter. Gee, I don't know where I've heard that before, but maybe it's a Rolling Stones song. As a quick aside, did you have to get permission, or how does that work?
Actually, we did look into it, and because it's not used in a song, therefore it was allowable. So we did check because it's not in a song. So
So
but
the
the Rolling
lyrics,
Stones are, one of my favorite band. And I kept thinking, I want to have a title that incorporates housing somehow. And actually it was one of my sales guys, Ted, who thought of it. And I was like, oh my God, that's perfect. Because it just suits me, my rock and roll background, and brings in housing and sort of my connection, and who I am, and hopefully defining me. Rolling Stones.
and did writing a book like that, did you underestimate the amount of time and energy it took? Did you overestimate it? Did you expect what was going to happen? How did that play out?
I definitely underestimated how much time it would take, and realizing that, there's a lot of things that I look back on now and writing it that I feel as if I could have told differently. You're always kind of in the evolving mode of your life. So I think that it's a very G-rated book. I mean, there's some good stories and a few, swear words, but I don't know. I think my children would describe it as, Mom, it's very G-rated. So I don't want to discourage anyone to reading it, but the real stories that lie behind some of the, at least on the surface stories, I didn't delve too deep into. So I tried how to keep it in the lane without really making it an X-rated book. No, just kidding. It was an exercise to know who my audience was. And I kept having to refine it and realize, really the purpose of the book wasn't just to tell stories to shock people. It was more to inspire and pay it forward. So I think that was a tougher exercise than I had expected. And it was cathartic in a lot of ways. And a lot of people along the way also helped me. So I had people like my partner, Dennis McGill, and Alan Ratner, who have worked for me since they were summer interns, and Kim, my assistant, my sister, my husband, read it and give me feedback. And it was a lot longer process than I thought.
Yeah. So two quick thoughts. First of all, this is more of a family show, although Rich occasionally, I think he has Tourette syndrome sometimes. He goes off on these rants, which are a little R-rated. But every once in a while, somebody will say, Rob, you should write a book on the capital markets, or you should write a book on secondary marketing. And I think, no way. I put out about 2,000 or 2,500 words a day, or 2,800. And I think I just couldn't, I just wouldn't want to do that. So
you could do the Corner Office, which was a series every week. You remember that article in the New York Times on C2? It was called The Corner Office. The author aggregated it all and created a book, and it's incredible. So you should take all your dailies and just put them all in a book, and little, preview.
I might have one of my offspring do that for a project. But anyway, we digress. Sorry, Rich. I know you want to talk about Ivy's thoughts on housing being overbuilt in the United States. So why don't you take it away?
Fully used to you completely derailing the show in the first 10 minutes. So yeah, it goes with the territory. So well, Ivy, let's get right into it, and let's start, I guess, right off the bat with a piece that Zelman and Associates put out not too long ago, a really contrarian piece. And Rob and I have been talking about housing inventory and just ad nauseum on this show for the last several months. And in a nutshell, the piece kind of paints a different picture, not one that America has been and is underbuilt by 4, 5, 6 million homes right now, and getting worse because of delays with the pandemic, but that America is overbuilt. And if you kind of look at the underpinnings of some of the demographics of America, population growth, household formation, that America is actually overbuilt, and we will see a correction in housing prices. And then what we're seeing now is kind of artificial inflation due to emotions and different factors related to the pandemic. So if you could just tell us a little bit about the piece and those general thoughts, I would love to hear your thoughts.
Well, I appreciate you asking, and I would say it's a pretty sobering report. And just to correct, we believe the pipeline of development, the level of the pipeline, which is really the latest 12-month housing starts, that pipeline is where we will be overbuilt in the single family market to normalize demand by over 20%. And in multifamily, given the pipeline, we'd be overbuilt to normalize demand in multifamily by 10 to 12%. So it's what's coming in the pipeline that's concerning. And what I would say is that right now, if you looked at completed units, it's pretty much an equilibrium to what that normalized demand number would be. So we're using normalized demand for single family at 900,000. And a lot of people are kind of taken back by that, because the demand number that everyone uses historically for total would be somewhere between 1.5 million, range of 1.3 million, 1.4 million. You add a few 100,000 for demolition and some excess inventory, excess vacancy, sorry. And what we recognize is that as you go back and look at, the history of the country from, call it World War II to today, we went through this ramp in the 70s and 80s of significant household growth. And where we are today, from the last prior 10 years, household growth slowed to the slowest ever on record. So you can't just use a historical number for demand. And people like to look at population and say, well, population's higher today than it was last decade or the decade prior. But it's really about the rate of change. And population growth in the United States was the second slowest on record, behind the 1930s by 10 basis points. So the population in the United States, sadly, only grew 7.4%. So when you look at the two numbers and the rate of change, you have to recognize that that means that we'll need less housing on a go-forward basis. And the people are asking that, are reading it, well, how can that be when inventories are at record lows and we have massive home price inflation? So there's a disconnect, Ivy. I don't understand it. And what I would say is that what a lot of it is being clouded by, one, again, a lot of this is in the pipeline, yet to be delivered. Secondly, because of the pandemic, we have a lot of people that have dual properties. Today, with mortgage rates at close to record lows, who wouldn't take advantage of the free money if they had the ability and go buy a second home, either vacation home, or a lot of people are actually trying to get diversification from the stock market. So we see a lot of private investors. We have what would I call liquidity investors today, whether it be instant buyers, better known as iBuyers, you have fix and flip buyers, and you have significant institutional capital that have entered the space. Especially the prettiest girl at the dance right now is built for rent, which just by itself in the last 18 to 24 months, $75 billion, which is predominantly unlevered, has been announced that they're going to build these build for rent communities, but they're not spread across the United States. They're really going to what I would call the smile states, the sand states, which you guys remember from the last downturn, the markets where household growth has been the strongest. So while our great state of Ohio, household growth, let's say, only has been growing for the last 20 years, 4%, and other states might be up, like in Utah, double digits, it's not the actual rate of households that you have to compare that to. It's how much production and supply is coming. So a lot of builders in Utah, for example, like, we're great because our household growth has been growing at a double-digit pace. And I said, yeah, but if you look at your starts and what's coming, it's up over 30%. So everything is the rate of change, not in absolute terms. And best example, and then I'll stop and you can ask some questions, is think about Japan. Unfortunately, Japan, where population prior to this prior decade actually was growing very negligible, but it was still growing. And while it was growing modestly, the housing starts and then a decline after this prior decade declined 40 to 70%. And right now, we as a nation are on the same trajectory in terms of slowing population growth, aging population, and a smaller percent of people under the age of 35 is what, unfortunately, we're on that trajectory. Now, the difference is that this country historically had been favorable on immigration, unlike Japan. But right now, our immigration numbers are pretty horrific, legal immigration. And that's a function of today's COVID environment, policy, public policy. Both sides of the aisle can't agree on immigration. So that's a way to solve this problem. But the cloudiness of what I'd call non-primary and just dual property ownership is really what makes the inventory constraints much more difficult to ascertain what it really means for underlying demand.
Many excellent points there. Thank you for that. And yeah, a lot of stuff to unpack there. And before I
And
go
also, I should mention, if you don't mind, Rich, just to make sure people understand that slowing household growth. People ask me why. Why is household growth slowing? And what you're seeing is that young adults that we would have expected would have unwound during post the great financial crisis, because when the number of adults living at home, 25 to 35-year-olds were living at home, 39-year-olds, sorry, that number we would have expected to go down post the great financial crisis after having risen. It actually went the other way. And a lot of that has to do with, we believe, women that are delaying family formation, marriage and family formation, affordability, just not the negative stigma to live in your parents' basement, but there's multi-generational living happening where you've got the boomers or the sandwich nation. They've got their adult parents, in-laws living with them, and then they got their adult kids living with them. So there's a lot of variables, but that's the predominant factor that surprised us, was the acceleration of adults living at home, where we would have thought that would have unwound. And it wasn't because of COVID, because we're looking at these, like, over the decade, every year, triangulating from the CPS, the ACS, all the surveys that are out there, and the decennial survey, while out, the numbers align. So it's not just a recent trend because of COVID.
Thank you. And we're starting to see some comments come in the chat. And as always, any questions, comments anybody has for Ivy, please feel free to drop them in the chat or the Q&A, and we'll incorporate them into the program. And Ivy, great points on institutional money and housing and dual owners. I think one thing that kind of caught the mortgage industry off guard a little bit, at least caught me off guard, was the previous iteration of the FHFA that oversees Fannie and Freddie. We're very hell-bent on, getting Fannie and Freddie out from underneath government control, and started to implement caps on things that in ways lenders could sell loans to the GSEs. And one of those was, non-owner occupied properties, and basically capped the entire mortgage industry at 7%, which was a little above the historical levels, just looking at stats and figuring it out that way. And then we get into the actual application of that limit, and lenders all across America were realizing they had far more than 7% non-owner occupied properties, and an inordinate number of second homes that were being bought for all the reasons that you mentioned. And I think that's part of your broader thesis, but if you could just expand a little, because this is a new dynamic right now that I don't think we've ever seen in America, where there has been so much buying from institutions, and just the person that lives in Ohio that's buying a second home in Florida.
Right.
How that impacts your overall thoughts on the matter here, and what some of the short and long-term impacts of that could be on housing in America more broadly.
Well, I think, anytime you have an incentive with rates declining as much as they did during the pandemic, and they still remain at very low levels. Think about people that live in New York, that are in New York City. During the pandemic, everybody wanted to get the hell out of Dodge, to get out of this densely, crime-ridden, scary place. So they went to the tri-state area, whether it was Westchester, New Jersey, or if it was Connecticut or the Hamptons, and they bought a home. There was McMansions in Greenwich that nobody could sell. And now all of a sudden it's 74% increase in second homes in Connecticut, the state, year over year, admittedly off a small base, but second homes were surging. And there were people that didn't want to go too far away from the city because they were concerned that their bosses might say, hey, you have to come in at least some portion of the week. So they might even have another property, let's say in Florida or in the Carolinas, if on the East Coast and the West Coast people, whether it be California, places like Arizona or in Texas. So we saw a lot of pull forward that I think now we're hearing people. I was just on a podcast yesterday, and the guy hosting it is like, yeah, we finally bought a home. Now we're going to sell our apartment in the city. We made the decision, but for a while, we weren't sure. So I think that that's a factor, but that's not even the biggest factor, because I think true second homeowners, I'm a second homeowner. I'm not selling it just because interest rates go up. If it's a place that my family and I enjoy going, but I think that it's not sustainable demand if you start to see any type of change in cost of capital. So that's one piece of it. The one area that I'd like to dig in a little bit is when we think about instant buyers, iBuyers, and you look at what their strategy is. Okay, they're going to provide a more delightful experience to the consumer. For me as a mother of three, I get it. if you got to sell your home, I mean, talk about a pain in the ass, right? You got to keep the house clean. You got to get out of the house. You got to fix up everything you think's wrong with it to help it sell it. They're coming in, giving you a bid in 3 days, contingent on inspection. You have to pay, to put lipstick on the pig, but you get out, you get your money. Well, they now own that house. So now they have to fix it up and then sell it. So it's all about velocity. And so when you look at inventory prior to the pandemic, inventories in the United States were at all-time record lows. And we had a pretty lackluster housing market. In fact, I would say anything but entry level was pretty much benign in home price inflation. All the home price inflation we were getting was at the very entry level. So tight inventories by itself doesn't tell us a lot. Part of the reason inventories were so tight is because we had people aging in place. We had landlords that liked their cash on cash returns, both mom and pop and institutions. And we had people that were locked in at low rates that didn't have an incentive to move. But housing wasn't in anything better. It wasn't by any means strong. It was okay. Entry level was strong. Move up and luxury were very weak. In fact, some luxury markets were under pressure. So that's pre-COVID. And now when you look at post-COVID and you look at what's happening with these instant buyers, as we're going to drill in one at a time at the investors. So now you say to the instant buyer, so what do you do if it's no longer a seller's market? And now you own this house that you say, you paid $500,000 for, and you got to put some money into it, deal with the labor inflation, deal with cost inflation on all your building products. And now you got to turn around and sell it. What happens if the market is not as favorable and you can't sell it for as much as you paid for it? What are you going to do? They're like, well, we're going to move it. We're going to sell it. So that's the difference between a primary owner and an investor. The investor has to turn it. So the velocity numbers is what I was going to. Pre-COVID, velocity, as I define as a home that's listed and sold in the same month. Pre-COVID, the velocity of the existing home market was running in the low 20% range. Okay, that was a pretty good number. And by post-COVID in 2021, January, we peaked at 50% velocity. So we're turning the inventory before in the same month that doesn't even show up as inventory. So I don't look at inventory in absolute levels. I look at what the velocity is, which is what's driving home prices. So if we have in Phoenix and in the Texas markets and the Atlanta markets and in various mountain states, we have a lot of investors that our whole business model is about velocity, then we're going to see home price pressure if they decide they have to sell to move the inventory to monetize and obviously reduce their cost of carry and their debt levels. So that's one investor we have to worry about. That's just the iBuyer. Then you also have what we call the backstop or bridge lend financiers who are giving you money so you can be competitive in a cash buying market where there's so many investors, institutional money, and they're going to help you. They're going to backstop your house and they're going to give you the money to go buy that house. So we have another investor type that's in there. Again, if the market starts to turn, are they going to move the inventory? Absolutely. They're not going to sit on it. So then let's talk about the institutional investors. The institutional investors that have been buying up existing homes, SFR, competing on the MLS, that are going to lease up these homes and get to the occupancy and return requirements that they need with renewal rates. Right now, renewal rates for single family rental are running in the high single digits. New move-in for single family rental is running in the low double digits. And then you have, so institutional capital has been prevalent really since 2011, 12, where it started to recognize this is an asset class that could actually do extremely well and maybe be like the multifamily industry that was originally in the late 90s, mom and pop, that got institutionalized, can make a better client experience, 24/7 service, all these other aspects. But now the residential market with very little alternatives, whether hospitality, retail, office, they're not very attractive. But today, investors want they want to have a return that's better than what government bonds can return or corporate bonds. So they go out and raise money, institutional investors, and they promise these, double-digit overall returns if you come and put your money with us, because we're going to go buy the best asset class in the country, which is residential real estate. So that's where a lot of the capital is going, and they're going into land or going to buy land in the same markets where the for sale builders are buying land, driving up lot prices in aggregate nationwide more than 30%, with the expectation that demand at the current levels is going to be somewhat sustainable, and they'll get to continue to raise rents in the face of what we think is going to be a people problem. Where are all these bodies going to come from? So you just take Phoenix, for example. Phoenix is the poster child of risk right now. And they're all building out in the tertiary markets because that's the only place you can buy land to even contemplate penciling a return. So the markets that are greatest at risk are not our friends here in Cleveland, where there's very little speculative development going on. It's in the markets where everybody, they're like sheep. They're all going to the same market, and they're looking for the market to sustain the level of demand to justify what they're telling their investors they can generate in terms of returns. So if demand moderates, there're going to be a lot of disappointed investors. And what are they going to do with those units? Right now, they're all long-term investors. We'll see. We'll see what they do. Will they try to sell it to the for sale market? Will they slow their purchases in the SFR market? Because all that velocity is not just primary. And that's what we're worried about, because we see the underlying demographics as a headwind, but you can't see it right now because it's cloudy.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman. And this week, special guest, CEO of Zelman and Associates, Ivy Zelman. And we're starting to have some comments and questions come into the chat. A couple around just affordable housing in general. Northeast Ohio, the homes between 100 and 275,000. Where Rob lives, the homes between 900,000 and $1.3 million. The lower priced homes, really just a dearth of supply right now. It's accentuated at those areas. You hear and you read and you see rents rising, and just it feels like the demand is still great there and will be continue to be great there. Your thoughts on just, I guess, the lower end of the market and the dynamic that builders, it just doesn't really make sense for builders to build homes under, say, $400,000 in Northeast Ohio for a myriad of different reasons. The potential impact, short and long term, of builders, I guess, no new affordable housing stock or very little coming into the marketplace.
The word affordable, I think, we just have to recognize that, today the average home price is over 300,000 in the US. And that's, what's affordable is really contingent on your income growth and whether, where mortgage rates are. So as variables go, if we lock in right now, theoretically, the market at today's median existing home price at today's mortgage rate is still deemed quote unquote affordable, but it's not. It's really the rate of change of monthly payment that matters. And right now, the monthly payment, even without rates going up very much, is on track to be up nearly 20% since the beginning of the third quarter. So where I would sit today is that there's really a moving target, and the builders and the for lease guys are all concentrated down at that price point. So it's concentration risk. And so you have any type of impact from, let's say, rates moving a tiny bit higher or continued price appreciation. I think that the market pricing is not inelastic. People are going to say no. My joke is the best way to cure inflation is just keep raising prices. And at some point people say no. It's like my daughter in New York City during, what was surge hours wants to take an Uber for $100. And I said, no, people are going to say no. And that's what's starting to happen in certain price points in parts of the country where I was talking to builders in Madison and Milwaukee, and they don't have a lot of development going on there. It's very fragmented, mostly private builders. And I asked them if you were able to pass along price, and they said, no way, no way. I mean, in Boise, Idaho, the market went absolutely gangbusters, and we have builders that have to cut prices right now because the market got so ahead of itself. I was laughing with a resident in Sun Valley that they went to look at a house that was $600,000, and they said it looked like a meth lab. They're like, I just can't believe what this stuff is listed for. So, we forget that not every home is in an ideal location that's in great shape. And right now, people are buying sight unseen homes. We're not seeing the same euphoria right now. We're starting to see normalization, but I think that affordability is a function of many variables, and it's also somewhat contingent on balance sheets and how levered they are. So I don't like to just say, yes, the market is affordable at this XYZ absolute price point, because it's contingent on so many other factors. But I think that we're seeing affordability incrementally being stretched because of the incremental increase in monthly payment, that's really the driver. It's the rate of change.
Couple questions in the chat. One just about percentages of homes that are purchased by iBuyers. Is that number out there anywhere? Do we have a sense, either officially or anecdotally, like what percentage of homes are bought by iBuyers and how that's likely to trend in the next year or two?
Right now, the market, I think the strongest presence is in Phoenix, and I think it's in the high single digits in terms of total transactions. So I think that relative to overall market, it's still a fairly small number, but you go into pockets, you have to remember that they are really situated at the lowest price points. So there's a buy box and they typically don't want to go above 500, 600. Zillow, we believe, went too far outside their buy box. They overpaid and they had to stop buying. They literally announced that they're not going to buy any houses until the end of the year. Will they resume purchase? Because I believe that their economics were so unfavorable because their algorithms and their models were wrong and they were buying houses and overpaying for them. And then they couldn't get the homes fixed up and they were selling them, they're selling them for loss. And now we're seeing them lowering prices. So to me, it's not about Zillow, okay, operationally, maybe they screwed up and poor execution, but it's more indicative of what the iBuyer risk would be as that velocity when they decide they need to get rid of whatever inventory they have, what they are going to do and at what price they're going to sell it at. So it's a small percent, but within what price point, it becomes a much bigger percent. And in certain zip codes, it's a much larger percent. So to look at a total MSA is somewhat maybe not as meaningful, but to answer your question, I'd say it's still a fairly low number. And I think it's going to grow because consumers want liquidity, but the iBuyers actually think that when the market gets challenging, that you and I are going to pay not 5%, we'll pay 14%. And I don't believe that. I don't think they will. I think they're just not going to move. And one of the biggest backlashes of the worst Fed policy in the history of policy decisions to continue to buy MBS, 40 billion a month to keep rates artificially low. It's great when the party's lasting. My joke is that Jay Powell's the bartender and continuing to serve an overserved crowd. At some point, you got to pay the piper. So you pull back, you start tapering, rates go up. If rates went to 4% in the United States, I'd say that would literally slow down the housing market substantially. Why? Because 67% of homeowners are locked in below 4%. So while we see the great American shuffle and people are moving, and that's how it's been referred to, the majority of Americans are not millionaires or billionaires that can go from New York to Miami or LA to Austin or San Francisco to Austin or to Boise. They are where they are. And in fact, more of them are consolidating households rather than expanding. So I think that there's risk that rates on the margin are really going to be a factor that's going to shut mobility down if they were to rise just to as little as 4%, even 3.75. There's 55% of people that are locked in below 3.75. So I don't know, you guys are rate gurus. You probably know better than I what rates are going to do, but if the Fed is tapering, at some point rates likely are going to rise. And that's really going to change the dynamics of both investors and primary buyers in the market.
Yeah, it's going to be interesting to see. And,
maybe rates will never go up. So, maybe the party keeps going on and everybody just keeps getting wasted. I don't know.
It's going to be interesting to see. MBA, Mortgage Bankers Association, just came out last week and put their 2022 forecast out and did project 30-year fixed rates to go up to 4% as we get into the fall of next year. And certainly that could have dramatic impact.
And it happened in 18. Everybody's like, oh my God, the mortgage rates went from, a little over 4 to 5. And our proprietary home building survey was up double digits year over year for the first half. And by the fourth quarter, it was down double digits and builders were incentivizing and they were cutting price. And while that was short-lived, because good news, Jay Powell cooperated with Trump and they started easing and rates came back down. So kind of saved the day because the rates where they were, the housing market was halting. I'm sure you remember.
I do. Yeah. So some great questions coming in the chat. One here, given that large builders need to continue to build and sell, what would they do differently given your view? Is it just market focus or is it the oversupply concern, a national topic overall? I can't imagine oversupply is an issue in California.
I think that it's hard for anyone to really triangulate the idea that we have a pipeline that could provide overbuilding. It just is because we don't see it, unless we see it, we can't believe it. And, I think what you're going to find is that our builders, the public builders account for over 40% of the new home market and they're machines. It's the only factory in the world that when you finish your factory, you basically have to shut it down and build a new factory. So they have no choice because that's what they do for a living is buy land and build homes. So I can't imagine a public company is going to come on at a conference call and say to the analyst community, you know what, I'm a little worried about land inflation and demand being sustainable. So I'm going to pull back on land purchases. You don't see it. That's not what they do. They're builders. They build land, they build houses. So I think that as well as their concentration risk, because they're all in those smile states predominantly, not all, but a much higher percent. And then you look at, okay, well, the private builders, what are they doing? They're talking, how do I get defensive here? How do I think about the positions I have today and the duration of those land development projects that I have? So I think it's about mitigating your risk by not having too much concentration in a particular market and continuing to buy more and more land at these inflated prices. I think that you see some builders are getting more cautionary by using options and using land banking, but there's still risk. It's a cyclical business. And, I have some builders telling me, well, we've got this massive deficit, so we've got to ramp communities. There's so much community count growth, new stores, so to speak, that they're ramping up and proudly telling us they're going to ramp 15, 30, 40% growth in communities, that means they're just jamming their foot on the gas and they're just assuming that the market's sustainable, and they have the comfort and backdrop of this consensus view that NAR and Freddie Mac, everybody's saying there's a 3 to 6 million unit deficit. What do I care? Pricing's inelastic. I could just build it and they will come like a field of dreams. Just build as much as I want. But because we don't see it yet, and we have all those investors, it's a little complacent out there right now.
I'm selling all my home builder stocks. Is
We're neutral. We're neutral on the stocks because I promise you, as Rob will tell you, we have our hand on the pulse. Every month, we're aggregating hundreds of builders that account for almost 20% of new home sales. And we know when the market starts to turn. And right now, the market did start to normalize really over the summer into really after Labor Day. And then rates started going up. So we have these fence sitters now that tend to jump into the market for a few months as rates rise. And that's artificially, we think, driving incremental demand through these non-seasonable typical months and giving the builders a false sense of comfort. So they're speccing like crazy too. Because guess what? If you sign a sales contract right now, and if you and your wife signed a sales contract for $500,000 and in 12 months they delivered your house, it might cost them another $100,000 because building products and labor and all the inputs have been so inflationary. So they don't want to sign contracts. So they're speccing. They're speccing under the presumption that they're going to ramp up their new communities, spec like nuts, and we're just going to have all these bodies materialize. And that's the question then, is when do we tell you to short the stocks? Is when we start seeing it showing up in our surveys, and we will. And that's the way we've been able to basically stay ahead of the curve. So we have a broker survey, we have a mortgage survey, we have every silo within the ecosystem. So we can take all these pieces of information that are significant sample sizes that are north of 90-95% R squared to the public companies in that space, and we'll know when to short the builders. We'll know when to short housing. And right now you can be more on the sidelines because who knows what's going to happen with rates? And we don't know how long the investors are going to be in the market. Like I said, party on. Maybe the market's going to stay strong for longer than we anticipate. So I'm not ready to short them and I'm not ready to sell them, but I certainly don't want to be long them.
Good stuff. Rob, I feel like I'm monopolizing all the conversation, little Cleveland party here. Any questions for Ivy?
No, I did
Great backdrop though, Rich, by the way, your poster.
I did see a question pop up about prefab. Ivy, do you have any idea what, and I guess prefab is kind of a generic catch-all phrase for manufactured homes or built in a factory and assembled on site, so forth. Any idea about what % of new construction is prefab?
Very small amount. I mean, manufactured housing has been sort of in the doldrums for the past decade. I used to follow the stocks back in the 90s. So it's been under secular pressure for the last few decades. And the numbers I don't have off the top of my head, but I think very little is being built completely in the factory, negligible levels. And I think that's a function of builders that, kind of like dinosaurs, they're used to doing it one way. And by the way, if you tell a builder, well, your returns are going to be better if you do it in the factory, but it's going to cost you a little bit more, you're going to lose 9.5 out of 10. The minute you talk about it's going to cost you more to go build it in a factory, but we'll turn your money faster. Right now is not something that builders are really buying in. Now they're doing components in the factory. They have been, whether it be roof trusses, floor trusses, panels. So there's stuff that is done in the factory, but from completed homes in the factory, other than manufactured housing, it's a very small number.
So another viewer's question about EDUs. And I know certain states, certain communities have promoted these dwelling units, made the zoning a little more ADU friendly. Do you see that as having any kind of impact on the housing market? And if what you say is true about the demand not necessarily being there, why the change in ADUs around the country, in ADU zoning and approval process?
I don't know enough about it, and I can only say that we're watching it, but the numbers right now are too small to be anything but watched and monitored, but I don't have any opinion about it. Sorry.
Yeah. Okay. Another question was, or kind of a generic question that's out there, and you mentioned price points a few times, and Rich and I talk often about price points. When you get into, Manhattan, for example, there might be somebody who's trying to sell their apartment or co-op or whatever it might be, and they might be asking, 4 million or 8 million or however many million, and it sits on the market for months and months, just because the number of buyers out there for something at that price point are relatively slim. But if you're building a $300,000 house in Modesto, California, it's going to fly off the shelf, especially in an environment where you have people, I think the last statistic I saw talked about how there are 5 million people a year turning 30 years old or entering the prime home buying market. And they're not necessarily in the home buying market for second homes on a lake shore in northern Wisconsin or someplace like that, but they might be in someplace like Modesto or some, Milwaukee or someplace like that. The what you're talking about in terms of being over, the demand overbuilt or underbuilt or whatever it might be, if you look at the typical market for, say, a first-time home buyer, let's say a price of 300, 400, 500, isn't what you're talking about different, say, than the market for $1 million and above in many of these areas?
Yeah, I mean, of course, but keep in mind that the bread and butter of the United States, over $500,000 in terms of total transactions, is probably 15% of the market. I mean, it's 85% of the market is built kind of under half a million or below. So when you really look at what the transactions are, where the transactions are happening in bulk, it's not that multi-million-dollar condo in New York City, or even, 7 figures of the skew to California. When you look at San Diego, what percent is above $500,000? It's probably 50%. But you go into Phoenix and it's 13% or 10%. So every market's different in terms of where the transactions are actually coming from. But your perception in Modesto or anywhere in a $300,000 home, you have to remind you, right now we have something called a GDI index, which looks at 2,300 micro markets, and we look at where development's happening. And when you look at the for rent guys, they're building the same box. It looks just like the for sale house. In fact, the rent versus the monthly payment could be even more than in a same square footage, 4-bedroom, 3-bath house, could be more for the for rent. So you've got the for rent community within a mile from the for sale community, and the community ramp of what's coming and all the capital that's yet to be fully deployed is going to result in a lot more supply. So the question is, where are all these bodies? You looked at the market by saying, 5 million new people millennials entered in the ages, or they should be home buyers. You have to look at the rate of change, because what was it last year? What's the percentage change, not the absolute number? And oh, by the way, women, of course, are better than men, but that's an aside. Women are going and pursuing their higher education. It's fun. The trajectory of women between the ages of 25 and 34 that complete a 4-year degree has been an upward rise that now is approaching 50%. Men are going the wrong way. They're going down. But the important part of women going after a 4-year degree or more is that the correlation to them having children plummets. So women that don't finish high school are more than 50% of them have a child or more. If you look at women that actually complete a 4-year degree or higher, 13% have children. So you've got women fertility rates plummeting. You've got people delaying marriage. And when they do have families, they're doing one and done. So this idea that they're entering a certain age is really not what it's about. The catalyst for buying homes is about family formation. 84% of households in the United States that are married couples with 2+ children live in a single family home. So it's really family formation that drives the decision, because it's hard enough to be married, live in 900 square feet with a husband and a child, you're going to move out. And when you have two children, you'll either get divorced or you'll move. It's about children that drives that lifestyle decision, not your age, with all due respect.
So do you think, and I don't know, I don't have the statistic, what you're saying is the household formation is declining every year now?
The rate of growth is decelerating, which is the key part of understanding. Think of it this way, Rob. If you have a factory and you're running flat out at 100% and you get an order, you're going to have to incrementally add more capacity. So it's the incremental order that matters if you don't have the capacity. So what we're looking at is incremental growth is slowing, but we're jamming on the gas to bring as much product as we can using an old absolute number as our demand variable. So do we really need that incremental capacity at the rate of growth when our incremental demand is decelerating? And you can see it in the numbers. I mean, the decennial survey is 100% sample size. You can't argue with the demographics. Like either that or you don't believe any government number out there. If you can't believe the decennial survey that's done every 10 years, it's 100% sample size, then don't believe any government number. That sample size is like the housing vacancy survey. That's like 60,000 units that are surveyed. I mean, it's a matter of understanding that the data, and not just one decade, for the last several decades, has been pointing in the wrong direction. So I'm really focused on the incremental change, not the absolute.
Yeah, we have a comment from a listener saying China is in real trouble if you're looking at the, that kind of index. And then another reader asked, with the remote nature of work, less and less people are occupying large commercial office buildings. Do you see these buildings potentially being converted to residential as a way to support affordable housing?
I think there's definitely people that are looking at that, as a sort of long-term possibility, but, we don't follow the office market, but it's disconcerting. Especially disconcerting is the amount of pipeline for multifamily in the urban markets that is yet to be delivered. We're at multi-decade highs right now that have yet to be completed units. A lot of that was pre-COVID being developed in the urban cores. So there seems to be a mismatch of where all this development is coming. In the last 12 to 18 months, all the new development in multifamily has been really in suburbia. And that's because this perception that everybody wants to be out of the cities. So we're going to see that pipeline kind of move, but it's still a boatload of pipeline in the dense, more urban markets. So we'll see what they want to do with it, but there's plenty of supply that's coming that's already designated for multifamily, that's already in process, just not yet completed. So I think it's going to be tough slaying if they try to convert, but I know that there's many that are strategically attempting to think about it.
And there's another listener saying, as an Austin resident, it feels like construction will not be able to catch up to the demand for a long time in Austin. Any markets where you think the inflow of new residents will actually meet the supply coming down the builder pipeline?
I think Austin's one of the markets, I hate to say it, that I'm concerned about more than others, even though the job growth is there strong and household growth has been strong, the supply coming is stronger. And you're right now the builder's best friend is the fact that they can't get the homes closed and they have supply chain problems, and problems is an understatement. But rates go up a little bit, demand will slow pretty damn fast, and builders will be able to build houses. You start getting those ports in Long Beach and LA start getting unbottlenecked, and you start getting the source product from Asia. If that all unwinds, a lot of the specs right now, the amount of inventory that's started in the pipeline is the highest that it's been in decades in total. So people underestimate how much production is coming. In Austin, it's coming. It may take longer for what we're concerned about to play out, but I do believe that the price appreciation in Austin is really giving people some pause, given that home prices are up over 30%. So the demand piece in Austin could slow as the supply is ramping, even though right now you can't see it coming, or you don't see enough of it.
This is the Rundown with Rob and Rich. Rob and I are very pleased this week to be joined by special guest, CEO of Zelman & Associates, Ivy Zelman. Ivy, really appreciate all the compelling commentary. We've already gone over time, continue to have questions, comments, a lot of nice words for you coming in the chat. One last question I had, just population migration in general. kind of fueled by the pandemic. We hear from our lender members in cities like Austin and Nashville and other growing Midwestern cities that they're getting influxes of people from the coast. You hear about it anecdotally from the national media. Do you think there's really anything there? I haven't seen any statistics yet of any note that has pointed to anything significant. Do you think that we're going to see any meaningful population migration within America once all the dust settles?
Well, I call it the Great American Shuffle. Has been happening for, the last decade. So if you look at the mountain states, the Southwestern markets, they've been the beneficiary of people leaving high cost states to lower cost states, and a lot of where the job growth has been coming. So it's really the incremental acceleration that people have been focused on. I know talking with one of the builders on their public conference call, they were like, oh yeah, 40% of our buyers are coming from California into Phoenix. I was like, well, what was it? What was the 40%? Was it 30%? Was it 20%? And arguably maybe it was 30%. But we look at postal office requests for address changes. And I'll just give you an example in the state of California. Guess how many people left the state of California in 2020? 0.3%. 70,000 households left the state of California. Now, many of them maybe left coastal to go inland, but the idea is that this mass exodus is happening. I think it's about, once again, the incremental and really looking at the rate of change. I do think with tax likelihood for tax increases coming, especially in areas in the Northeast, like in New York or more in California, to pay for all this, stimulus that we've been putting into the market, that might cause that acceleration to continue. And markets that are more favorable, like, the state of Florida or Texas, could be the beneficiaries of that. So I think there'll be winners and losers. But again, it goes back to how many households in those markets are being formed rate relative to the amount of production. So it's all about those rate of changes. So I'd be more bullish on some of those markets if I knew that the builders can control themselves, or the not just for sale builders, but the for rent guys that are bringing all this production, and maybe the bottlenecks will save them from themselves. So they can't bring it on. It's their own regulator, which is they need right now.
Thank you. Ivy, thank you once again. And Rob, any final questions for Ivy? Any big Halloween weekend plans? I heard you're dressing up as Rohit Chopra to terrify people for Halloween.
He's just doing his job, Rich. Just doing his job. No, I plan on actually going out on the ocean tomorrow. Maybe do a little fishing.
Way better.
Today's my daughter's 17th birthday, so we'll have a birthday weekend. So excited about that. That's
right. Where you go? What restaurant in Cleveland you taking her to, if you don't mind me asking?
Where else would we go, Rich? We got to go to Red. It's like the only restaurant nice restaurant in Cleveland. Also Giovanni's. We love Giovanni's.
Giovanni's in Beechwood is phenomenal.
Probably too old for Chuck E. Cheese.
Thank you guys for having me. Appreciate it.
Thank you so much for joining us. And again, the link to go purchase Ivy's new book is in the chat. And please support her in the book. It's I have not read it personally, but I did order it this morning, and looking forward to reading it. And really appreciate you joining us this afternoon. And thank you. I really appreciate it.
All right, guys. Absolutely. Have a great day. Great weekend. Happy Halloween.
I had the link in my commentary today. So
thank you. Thank you, Rob. Appreciate it.
Hopefully it's
all right, guys. Happy Halloween.
Happy Halloween. And to our attendees, thank you very much for taking some time out with us. We're here every Friday, 3 p.m. Eastern with the Rundown and Rob and Rich. And everybody have a happy, fun, and safe Halloween weekend. And we will see you next Friday. Take care, everyone.